All right, ready to dive in. Today we're taking a deep dive into Warren Buffett's 2011 letter to Berkshire Hathaway shareholders.
Oh, yeah, this one's a classic, especially if you're interested in how he navigated kind of a turbulent economic period.
Definitely. And I think it's always fascinating to see how his thinking evolves over time.
Yeah.
And how he adapts his strategies to different market conditions.
Absolutely, and this letter is no exception. I mean, even when the market's a little shaky, Buffett always seems to find a way to deliver value for Berkshire shareholders.
He really does.
Right.
So let's start with the basics. How did Berkshire perform in 2011?
Well, the company saw a 4.6% increase in book value per share.
Okay, 4.6%.
Yeah.
That might not sound like a home run to some people, but let's put that into perspective.
Right, because that translates to a compounded annual gain of almost 20% over 47 years.
That's the magic of compounding, right?
Exactly, and to put that into even more context, the S&P 500 gained about 6,397% during that same period. But Berkshire, brace yourself for this one, over 513,000%.
Wow, talk about outperforming the market.
That's not just outperforming, that's like running circles around it.
It's a whole different ballgame. Now, beyond the numbers, this letter also gives us a glimpse into the future of Berkshire. I was particularly struck by his emphasis on succession planning.
Yeah, he's very clear about the importance of having the right people in place to continue his legacy. And, this is where we first meet Todd Combs and Ted Weschler.
Yes.
Dynamic duo. Right. He brought them on board specifically to manage investments for Berkshire, and it's clear that he had tremendous confidence in their abilities.
He's got a knack for spotting talent, and then he trusts them to make decisions. He even mentions in this letter that he's already chosen his successor as CEO.
But of course, he doesn't reveal the name. He likes to keep us guessing.
Part of the mystique, right?
It certainly adds to the intrigue. But speaking of big moves, 2011 was also a year of major acquisitions and investments for Berkshire.
Oh, yeah. He went on a bit of a shopping spree. What were some of the highlights?
Well, one of the biggest was the acquisition of Lubrizol, the specialty chemicals company.
I remember that one. It was a significant deal.
It was, and it shows how Buffett is always looking for companies with a durable competitive advantage. Lubrizol had a great track record, and Buffett saw its potential for continued growth.
And he even mentions in the letter how they were already looking at bolt-on acquisitions for Lubrizol. It's like he's always thinking several steps ahead.
Like a chess master, always planning his next move.
Exactly. And then there were those two huge investments in marketable securities. The $5 billion in Bank of America preferred stock and the $10.9 billion stake in IBM.
Those were game changers, and they really highlight his confidence in those companies.
And of course, IBM. That brings us to the famous Big Four American Express. Coca-Cola, IBM, and Wells Fargo. These weren't just stocks to Buffett. They were cornerstones of his portfolio.
He views them as ownership in truly exceptional businesses. He's not just buying pieces of paper. He's buying into the long-term success of those companies.
And that ownership mentality really shines through in his discussion of unreported earnings.
Yes.
This is something that I think a lot of people don't fully grasp.
Yeah, it's a little complicated. But basically, Berkshire's financial reports only reflect the dividends they receive from these companies, but their actual share of the earnings is far greater.
So there's kind of a hidden treasure chest of earnings that's not fully reflected in the financial statements.
Exactly. In 2011, the dividends from the Big Four totaled $862 million, but Berkshire's share of the earnings was over $3 billion.
That's a huge difference.
It is. And Buffett argues that these unreported earnings are just as valuable as the reported ones. They contribute to Berkshire's overall intrinsic value.
So it's like having a secret stash of wealth that's quietly growing in the background.
Exactly. But of course, it's not all sunshine and rainbows. Even Buffett makes mistakes, and he's very upfront about that in this letter.
Yeah, I appreciate his honesty.
Yeah.
He openly talks about his $2 billion investment in Energy Future Holdings bonds, which turned out to be a major miscalculation.
He admits that he completely misjudged the situation and that the declining natural gas prices caught him off guard.
It shows that even the Oracle of Omaha isn't infallible.
It makes him a little more human, right?
Definitely. And speaking of things not going as planned, he also addresses the ongoing housing market slump in this letter.
That was a tough time for a lot of businesses, and Berkshire was no exception.
Yeah, 5 other businesses were directly affected by the slump, and their combined pre-tax profits took a pretty big hit.
It's interesting because he actually admits being wrong about his prediction of a housing recovery in 2011. He thought things would turn around more quickly, but the market stayed sluggish.
It shows how even the best investors can get things wrong sometimes.
Predictions are tough, especially when you're dealing with something as complex as the housing market.
Absolutely. But even in the face of these challenges, Buffett remains optimistic, and he continues to emphasize the importance of thinking long-term.
That's one of his core principles. He's always focused on the big picture, and he's not swayed by short-term fluctuations.
And that long-term perspective really comes through in his discussion of how he and Charlie Munger measure success at Berkshire.
It's not just about book value. They look at the rate of gain in intrinsic business value.
That's a crucial distinction.
Oh,
So what exactly is intrinsic business value? How does it differ from book value?
well, book value is just a snapshot in time. It's the accounting value of a company's assets minus its liabilities. But intrinsic business value takes into account all sorts of factors, like a company's earning power, its management team, its brand, its competitive advantage, and its long-term growth potential.
So it's like looking beyond the numbers and trying to understand the true worth of a business.
Exactly. And Buffett believes that intrinsic business value is a much better indicator of a company's long-term potential than book value.
It's like trying to assess the value of a house. It's not just about the square footage and the number of bedrooms.
Yeah.
You have to consider things like the location, the neighborhood, the condition of the property, and the overall market conditions.
That's a great analogy. And just like with the house, the intrinsic value of a business can fluctuate over time depending on a variety of factors.
So it's not a static number, it's a moving target.
Right, and Buffett is always trying to assess that intrinsic value and compare it to the current market price of a stock.
He's looking for those opportunities where the market price is significantly lower than the intrinsic value.
He wants to buy those undervalued treasures that everyone else seems to be overlooking.
He's a bargain hunter at heart.
He is. And that brings us to his discussion of share repurchases, which I think is one of the most interesting parts of this letter.
I agree. He explains why Berkshire is willing to buy back its own shares, even at a premium to book value.
It's a strategy that a lot of companies shy away from, but Buffett believes it can be a very effective way to create value for shareholders.
He lays out two conditions for repurchases. First, they need to have ample funds for operations, and second, the stock must be trading at a material discount to intrinsic value.
So he's not just buying back shares for the sake of it. He's doing it strategically when he believes it makes sense for the long-term health of the company.
It's all about creating value. And that leads us to his fascinating concept of personal calculus, which he uses to explain why Berkshire benefits when IBM's stock price goes down.
This is one of those counterintuitive ideas that makes you scratch your head at first, but when you think about it, it makes perfect sense.
So how does this personal calculus work?
Well, basically, Buffett argues that Berkshire, as a long-term shareholder of IBM, benefits when IBM's stock price underperforms because it allows the company to buy back more shares at a lower price.
So it's like being happy when the price of gas goes up because you just filled up your tank.
Exactly. It's a way of thinking that goes against conventional wisdom, but it highlights Buffett's long-term focus and his understanding of how stock buybacks can create value.
And of course, he gives a nod to Ben Graham, his mentor, who taught him the importance of not being swayed by the daily fluctuations of the stock market.
Graham's teachings had a profound impact on Buffett's investment philosophy, and they continue to guide his decisions today.
It's amazing to see how those lessons from decades ago are still relevant in today's market.
Timeless wisdom never goes out of style. But
Mhm.
speaking of things that have stood the test of time, let's talk about insurance float, which is a core element of Berkshire's success.
This is a concept that can be a little confusing for people.
Mm.
So can you explain it in simple terms?
Sure. Float is basically the money that insurance companies collect in premiums but haven't yet paid out in claims. It's essentially free money that they can invest while they wait for those claims to come in.
So it's like having a giant line of credit that you don't have to pay interest on.
Exactly. And Berkshire has been incredibly successful at generating float over the years. Their float has grown steadily, and it now stands at a staggering $70.6 billion.
Oh, that's a lot of firepower.
It is. And what's even more impressive is that they've achieved underwriting profits for 9 consecutive years, totaling $17 billion.
So their float is not only huge, but it's also essentially cost-free.
You got it. That's why Buffett calls it a revolving fund. It's this amazing pool of capital that they can use to invest in other businesses.
It's like having a perpetual money machine.
It's one of the key drivers of Berkshire's long-term success, and it all comes down to their disciplined approach to underwriting.
They're very selective about the risks they take on, and they're always looking for ways to minimize their losses.
They understand that the key to success in insurance is to price your policies correctly and to avoid those catastrophic events that can wipe out your profits.
Now let's meet the people behind this impressive insurance operation.
Okay, so we have 3 main players here. Ajit Jain, who runs Berkshire Hathaway Reinsurance Group, Tab Montross, who heads up General Re, and Tony Nicely, the CEO of Geico.
These are the all-stars of the insurance world.
They are, and each of them has their own unique strengths and expertise.
So let's start with Ajit Jain. He's kind of a legend in the reinsurance industry.
He is. He's known for his ability to assess and insure risks that others won't touch.
So he's the guy you call when you need to insure a skyscraper against an earthquake or a satellite against a meteor strike.
Exactly. He's a master of the complex and the unusual, and he's generated billions of dollars in profits for Berkshire over the years.
And what about Ted Montross?
Well, Tad is a very disciplined underwriter. He's focused on those 4 key principles that Buffett talks about: understanding your exposures, evaluating risks appropriately, setting the right premiums, and walking away from bad deals.
Simple rules, but powerful when applied consistently.
Exactly. And then there's Tony Nicely, who built Jai-Ho into the powerhouse that it is today.
Jaico is one of those companies that you see advertised everywhere.
They are. And Tony's leadership has been instrumental in their success. He understands the importance of operational efficiency and customer service.
So we got these insurance wizards on one side, and then on the other side, we have those regulated giants, BNSF and Mid-American Energy.
2 very different worlds, but both incredibly important to Berkshire's overall success.
It's an interesting balance.
Yeah.
You've got the insurance businesses, which generate float and provide capital for investments.
Yeah.
And then you have these regulated, capital-intensive businesses that provide essential services and generate steady, reliable returns.
It's like having your cake and eating it too.
It's a beautiful synergy. And both BNSF and Mid-American seem to be thriving under their respective leaders, Matt Rose and Greg Abel.
They're both very capable executives who understand the unique challenges and opportunities of operating in regulated industries.
They also seem to have grasped that social compact that Buffett talks about. The idea that businesses have a responsibility to serve their customers and their communities while also earning a fair return for their shareholders.
It's about finding that balance between profit and purpose.
Exactly. And both BNSF and Mid-American seem to be doing a great job of that proof. BNSF is playing a vital role in the U.S. economy, moving a huge amount of freight across the country.
And they're investing heavily in infrastructure to ensure that they can continue to meet the needs of their customers.
And let's not forget Mid-American's leadership in wind energy. They're miles ahead of the curve when it comes to renewable energy.
They've invested billions of dollars in wind and solar projects, and they're committed to making clean energy a bigger part of their portfolio.
It's like Buffett's acknowledging the futures in sustainable energy.
He's definitely putting his money where his mouth is on that one. But now let's shift gears and dive into that vast and incredibly diverse world of Berkshire's manufacturing service and retailing operations.
This is where things get really interesting. We're talking everything from lollipops to jet airplanes, all under one roof.
It's mind-boggling when you think about the sheer breadth of their holdings.
So what's the common thread that ties all these businesses together?
Well, as we've discussed, Buffett is always looking for businesses with a durable competitive advantage, strong management teams, and the potential to generate consistent earnings.
And he's not afraid to invest in a variety of industries as long as the fundamentals are sound.
Exactly. He's a true believer in the power of diversification, but he's also very selective. He's not just throwing darts at a board.
He does his homework, he kicks the tires, he talks to the management. He really gets to know the businesses he's investing in.
And he's not afraid to be patient. He's willing to wait for the right opportunity, even if it means sitting on the sidelines for years.
That's the lesson that a lot of investors could learn from.
It's all about discipline and long-term thinking. But let's be honest, not every business in this category is a home run. Buffett admits that he's made his share of miscalculations over the years.
Everyone makes mistakes, even the Oracle of Omaha.
He's human, after all. But what I find interesting is that Berkshire often holds on to those underperforming businesses, even when they're not setting the world on fire.
Why do you think that is?
Well, he talks about a commitment to the original sellers of those businesses. It's like a promise to keep them going through thick and thin.
It's a different philosophy than most investors who would just cut their losses and move on.
It's almost like he adopts these businesses into the Berkshire family. And while they're not afraid to make changes when necessary, they generally prefer to hold on and ride out the tough times.
It's a long-term view, and it speaks to their belief in the resilience of American businesses.
Exactly. And it's a reminder that even in the face of adversity, there's always hope.
Now let's focus on some of the standout performers in this sector, those companies that really showcase Buffett's knack for picking winners.
Okay, so one that comes to mind is CTB, an agricultural equipment operation that's been a real cash cow for Berkshire.
What's the secret to their success?
Well, they're a classic example of a bolt-on acquisition strategy. They grow steadily, making these smart strategic acquisitions that complement their existing business.
It's like they're constantly building and expanding their empire piece by piece.
Exactly. And they've got a great management team that understands their industry and their customers.
And then there's TTI, the electric components distributor. They've been consistently outperforming their publicly traded competitors.
It's all about strong leadership and a deep understanding of their niche.
They know their customers, and they know how to deliver value.
And then there's Iskar, the cutting tools operation that continues to defy expectations with its impressive growth.
They've managed to navigate difficult economic conditions, and they've made some strategic acquisitions that have strengthened their position.
They're a global player with a world-class management team.
Okay, enough with the high-tech tools. Let's talk about a company that keeps the wheels of commerce turning. McLane, the massive distribution company.
McLane is like a well-oiled machine. They distribute a wide range of products to convenience stores, restaurants, and other retailers, and they do it with incredible efficiency.
So they're the behind-the-scenes players that make sure products get where they need to go.
Exactly. And they're constantly looking for ways to improve their operations and expand their reach.
Now let's talk about a company that takes luxury to new heights. NetJets, the fractional ownership jet company.
NetJets. They've had a bit of a roller coaster ride in recent years, but they seem to be back on track.
They cater to a very specific clientele, right?
Oh yeah, we're talking about the high-flying elite here. Those who can afford a share of a private jet.
It's a niche market, but it's a very lucrative one.
And NetJets has built a strong brand and a loyal customer base.
And then there's Marmon, the conglomerate within a conglomerate that's like a mini Berkshire.
Marmon is a fascinating case study in decentralized management. They've got over 140 businesses, each with its own CEO and a high degree of autonomy.
So it's like a collection of independent entrepreneurs all united under the Marmon banner.
Exactly. And they've been very successful at finding strategic partnerships and joint ventures around the world.
They're a global player with a very diverse portfolio.
Now let's move on to a true Berkshire classic, See's Candies.
Yes, the chocolate empire. The perfect example of Buffett's buy commodities, sell brands philosophy.
They've generated over $1.65 billion in profits since Berkshire acquired them for a mere $25 million 4 decades ago.
That's what I call a sweet return.
It's a testament to the power of building a beloved brand and creating a loyal customer base.
And then there's Nebraska Furniture Mart, or NFM as it's affectionately known.
NFM is a retail giant. They're known for their massive stores, their unbeatable selection, and their low prices.
And they're expanding into new markets like Texas.
They're not afraid to grow, and they've got a great management team that's focused on customer satisfaction.
Now, before we move on to the next sector, Buffett throws in a little accounting humor, highlighting a situation at Marmon that shows how accounting rules can sometimes create distortions that don't reflect the true value of a business.
He explains how Marmon was required to write off a significant portion of a recent purchase price due to GAAP rules, even though the write-off had nothing to do with the actual economic reality of the situation.
So it's a reminder that while accounting is important, it's not always a perfect reflection of what's really going on.
Sometimes you have to look beyond the numbers and understand the underlying economics of the business.
Now let's shift our focus to Berkshire's smallest sector, finance and financial products.
This sector includes a mix of businesses, including rental companies, Ray, and Court Clayton Homes, the nation's leading producer of manufactured homes, and a collection of financial assets.
So we've got everything from trailers and furniture to homes and mortgages. It's a pretty diverse group.
It is, and they were all impacted differently by the economic turbulence of the past few years.
How so?
Well, the two leasing companies, Ray and Court, saw their earnings mirror the recovery in the broader economy. As the non-housing sectors rebounded, their businesses picked up.
So their fortunes were tied to the overall economic cycle.
Exactly. But Clayton Homes, which is heavily tied to the housing market, faced a much tougher road.
Why is that?
They operate in the world of manufactured housing, which, like site-built housing, was hit hard by the 2008 crash. Sales remained stagnant, reflecting the oversupply of homes and the challenges faced by lower and middle-income families, their primary customer base.
It's a reminder that even within a diversified portfolio, some businesses are going to be more vulnerable to specific economic headwinds than others.
And that's exactly what happened with Clayton Homes. They were directly exposed to the housing market slump, and it took a toll on their business.
So how did they manage to weather the storm?
Well, Buffett credits their conservative lending practices. They require meaningful down payments, and they make sure that monthly payments are aligned with borrowers' incomes.
So it was their prudent underwriting that saved them.
Exactly. They didn't get caught up in the subprime lending frenzy that brought down so many other companies.
It's a classic example of how sticking to your principles can pay off in the long run.
Absolutely. But Clayton Homes isn't out of the woods just yet. They're still facing headwinds from the slow housing recovery.
So what's the outlook for them?
Well, Buffett remains optimistic. He sees the eventual recovery of the housing market as a tailwind that will benefit Clayton Homes. Plus, their conservative lending practices and their focus on serving a growing demographic give them a solid foundation for future growth.
So it's a story of resilience and cautious optimism.
Exactly. Despite the challenges, they've managed to stay afloat, and they're well positioned to capitalize on the eventual rebound of the housing market.
Well, there you have it.
Yeah.
We've covered a lot of ground in this first part of our deep dive into Warren Buffett's 2011 letter.
We've seen how he navigated a challenging economic environment, how he thinks about intrinsic business value, and how he approaches everything from acquisitions to share buybacks.
It's been a fascinating journey so far, and there's still much more to discover.
In the next part, we'll delve into Berkshire's impressive investment portfolio, exploring their major stock holdings and Buffett's views on derivatives gold and the role of government in the economy.
So stay tuned for more insights from the Oracle of Omaha.
Welcome back to our deep dive into Warren Buffett's 2011 letter to Berkshire Hathaway shareholders.
All right, so we're back and ready to dig a little deeper into this letter. I'm really curious to hear more about this whole concept of intrinsic business value. He talks about it a lot, but what does it really mean? And how does he actually use it to make decisions?
It's basically the true worth of a business when you consider all its assets, its earning potential, and any other factor that makes it valuable over the long haul.
So it's not just looking at the stock price or what's on the books.
Right. It's about understanding the underlying strength of the company, its ability to generate profits and grow over time.
And he seems to believe that this intrinsic value is often different from a company's book value.
Absolutely. Book value is just a snapshot. It's based on the accounting value of a company's assets and liabilities. But intrinsic business value is more about looking at the bigger picture.
Okay, so it's a more holistic view. It's about trying to understand the true potential of a business.
And that's why Buffett puts so much emphasis on it. He believes that you should only buy a stock when it's trading at a significant discount to its intrinsic business value.
So you're basically looking for those hidden gems that the market has overlooked.
That's a great way to put it. It's like finding those rare opportunities where you can buy a dollar for 50 cents.
And he even uses that great analogy of shooting fish in a barrel.
Right. He says it's like waiting for the barrel to be drained and the fish to stop flopping before you take your shot.
It's classic Buffett. It's about being patient and disciplined, waiting for the right opportunity, and then pouncing.
He's not interested in chasing the latest fads or trying to time the market. He's looking for those rare companies that can compound value for decades to come.
And that brings us to another key aspect of his philosophy, his preference for productive assets.
This is something he's talked about for years. He favors investing in things like businesses, farms, and real estate over things like bonds or gold.
So what's the thinking there? Why does he believe that productive assets are superior investments?
Well, he argues that productive assets have this unique ability to generate real economic value over time. Regardless of what's happening with currencies or interest rates or even market sentiment.
They're the building blocks of the economy.
Exactly. They produce goods and services that people need and want. And that's why he believes they're the best way to preserve purchasing power over the long term.
It's about investing in things that create real value.
And it's about betting on human ingenuity, believing that people will continue to innovate and create new things that will drive economic growth.
And he uses those great examples of Coca-Cola and See's Candies.
Right. Those are businesses that have consistently delivered value to consumers regardless of economic conditions.
They've managed to adapt and thrive through thick and thin.
Exactly. But he also points out that not all productive assets are created equal.
Okay, what do you mean by that?
Well, some businesses like regulated utilities require significant capital reinvestment just to maintain their earning power.
Right, they have to constantly upgrade their infrastructure to keep up with demand.
Exactly. But other businesses like Coca-Cola or See's Candies can generate increasing profits with minimal additional investment.
So it's not just about finding productive assets, it's about finding those rare gems that can generate high returns on invested capital without needing constant infusions of cash.
And that's what Buffett and his team at Berkshire are always looking for, those companies that have that special sauce, that durable competitive advantage that allows them to compound earnings for decades.
But finding those companies is just the first step, right? He also talks about the importance of having the right people in place to run them.
Absolutely. He's a big believer in finding talented managers and then giving them the autonomy to make decisions.
He understands that the success of any business ultimately comes down to the people running it.
It's about finding those individuals who are passionate about their work, who understand their industry, and who can make smart decisions under pressure.
And then getting out of their way, letting them do their thing.
Exactly. Trust is a big part of his philosophy. He believes in empowering his managers and giving them the freedom to make mistakes and learn from them.
So it's not about micromanaging. It's about finding the right people and then giving them the support they need to succeed.
And it's a model that's worked incredibly well for Berkshire Hathaway. They've got a track record that speaks for itself.
Now, let's not forget the context of this letter. He was writing this in early 2012, just a few years after the financial crisis.
Right. The world was still recovering from that shock, and there was a lot of uncertainty about the future.
But even in the face of those challenges, Buffett remained optimistic about the long-term prospects for the American economy.
He's always been a believer in the resilience of American businesses and the power of the market to self-correct.
He sees the big picture. He understands that the economy goes through cycles and that downturns are inevitable.
But he also believes that the long-term trend is always up. He's got that faith in human ingenuity and the ability of people to adapt and overcome challenges.
And that optimism really shines through in this letter.
Yeah.
He's not blind to the problems, but he sees the opportunities as well.
He believes that America's best days are still ahead of us, and he's putting his money where his mouth is by continuing to invest in American businesses.
Now let's dive into the heart of Berkshire's empire, their vast and diverse portfolio of businesses. He breaks them down into four main segments: insurance-regulated, capital-intensive businesses, manufacturing service and retailing operations, and finance and financial products.
Right. It's a truly remarkable collection of companies.
We've already talked about insurance and those regulated giants like BNSF and Mid-American Energy.
Yeah.
So let's focus now on that sprawling world of manufacturing service and retailing operations. It's really a grab bag of businesses, everything from industrial behemoths to beloved consumer brands.
It's amazing to think that Berkshire owns such a wide array of companies.
So what's the common thread that ties them all together? What's Buffett looking for when he decides to invest in a business?
Well, as we've discussed, he's always looking for those companies with a durable competitive advantage, strong management teams, and the potential to generate consistent earnings. He's not afraid to invest across different industries as long as the fundamentals are sound.
So it's not about sticking to a particular sector or following the latest trends. It's about finding those timeless businesses that can deliver value regardless of the economic climate.
Exactly. He's not looking for those flash-in-the-pan companies that are here today, gone tomorrow. He's looking for those steady eddies that can compound earnings for decades to come.
And he's willing to be patient, right? He's not in a hurry to make a quick buck. He's thinking long-term.
Absolutely. He's willing to wait for the right opportunity, even if it means holding onto a stock for years or even decades.
And that's a lesson that a lot of investors could learn from. We live in a world of instant gratification where everyone's obsessed with short-term gains. But Buffett is playing a different game. He's thinking generationally. He's building a legacy.
And that's one of the things that makes him so unique. He's not just an investor, he's a steward of capital.
Yeah.
He's thinking about the long-term implications of his decisions, and he's trying to create value not just for himself, but for future generations.
Now let's dive into some of those specific businesses that make up this vast portfolio. We've already talked about some of the stars like CTB, TTI, ISCAR, and McLean, but there's so many others. What are some of the other businesses that stand out to you?
Well, one that comes to mind is Marmon. It's like a mini Berkshire with over 140 businesses operating across 11 different sectors.
So it's a conglomerate within a conglomerate.
Exactly. And they've been incredibly successful and under the leadership of Frank Pietek. They've achieved consistent internal growth, and they've made some very shrewd acquisitions over the years.
What's their secret? How do they manage such a diverse group of businesses so effectively?
Well, as I mentioned earlier, Buffett is a big believer in decentralized management. He gives his managers a lot of autonomy, and that's certainly true at Marmon. Each of their businesses has its own CEO who is responsible for day-to-day operations.
So it's like a collection of independent entrepreneurs, all united under the Marmon banner.
Exactly. And they've also been very successful at finding strategic partnerships and joint ventures. For example, they have a very profitable partnership with the Kundalia family in India.
So they're not afraid to look beyond U.S. borders for growth opportunities.
Exactly. They understand that the world is becoming increasingly interconnected, and they're willing to adapt their strategy to capitalize on those trends.
Now let's talk about a business that's near and dear to Buffett's heart. See's Candies.
Ah, yes, the chocolate empire. It's a classic example of Buffett's buy commodities, sell brands philosophy.
He's always said that he loves businesses that have a strong brand and a loyal customer base.
And See's Candy certainly fits that bill. They've been making delicious chocolates for over a century, and they have a loyal following of customers who swear by their products.
What's their secret? How have they managed to stay so successful for so long?
Well, they've always focused on quality and consistency. They use the finest ingredients, and they've never compromised on their standards. They also have a very strong brand identity. Their packaging is iconic, and their stores have a very distinctive look and feel.
So they've created a brand that people trust and love,
Hmm.
and that's translated into consistent profits for Berkshire Hathaway.
Exactly. They've found that sweet spot between indulgence and nostalgia.
And speaking of businesses that have built a strong brand and a loyal following, let's talk about Nebraska Furniture Mart.
Ah, yes, NFM. They're known for their massive stores, their vast selection, and their incredibly low prices.
They've been incredibly successful, growing their earnings tenfold since Berkshire acquired a stake in the company back in 1983. What's their secret? How have they managed to achieve such impressive growth?
Well, they've got a really simple business model, offer a wide selection of furniture at unbeatable prices, and they execute that model brilliantly. They have a relentless focus on customer satisfaction, and they're constantly looking for ways to improve their operations.
And they're not afraid to expand into new markets. They're currently building a massive new store in Texas.
Exactly. They see an opportunity to replicate their success in a new market, and they're not afraid to invest the capital to make it happen.
It's a reminder that even in a mature industry like furniture retail, there are still opportunities for growth if you know what you're doing.
And it's a testament to the vision and leadership of the Blumkin family, who run NFM Pandem. Buffett has a lot of respect for them, and he's often praised their entrepreneurial spirit and their commitment to customer satisfaction.
Now, before we move on to Berkshire's other businesses, I want to touch on something that Buffett mentions in this letter that I found really interesting. He talks about a situation at Marmon that highlights how accounting rules can sometimes create distortions that don't reflect the true economic reality of a business.
Yeah, he explains how Marmon was required to write off a significant portion of a recent purchase price due to GAAP rules, even though the write-off had nothing to do with the actual value of the business they acquired.
So it's a reminder that while accounting is important, it's not always a perfect reflection of what's really going on in a business.
Exactly. Sometimes you have to look beyond the numbers and really try to understand the underlying economics of the situation.
Now let's shift our focus to Berkshire's smallest sector, finance and financial products.
This sector includes a really diverse group of businesses, including rental companies, XTRA, and Court Cleaton Homes, the nation's leading producer of manufactured homes, and a collection of financial assets.
So we've got everything from trailers and furniture to homes and mortgages. It's a pretty eclectic mix.
It is, and these businesses have all been impacted in different ways by the economic ups and downs of recent years.
How so?
Well, the two leasing companies, XGRA and Court, saw their earnings pretty much mirror the broader economic recovery. As the non-housing sectors rebounded, so did their businesses.
So they were beneficiaries of the cyclical upswing.
Exactly. But Clayton Homes, which is heavily tied to the housing market, faced a much tougher road.
Why is that?
Well, they operate in the world of manufactured housing, which, like site-built housing, suffered a pretty prolonged downturn after the 2008 crash. Sales remained stagnant, reflecting the oversupply of homes and the challenges faced by lower and middle-income families, their primary customer base.
So they were really caught in the crosshairs of the housing crisis.
Exactly. And it definitely took a toll on their business. But despite those challenges, they managed to avoid major losses thanks to their conservative lending practices.
So they were prudent underwriters, which helped them weather the storm.
Exactly. They didn't get caught up in that subprime lending frenzy that brought down so many other companies.
And while they're still facing some headwinds from the slow housing recovery, Buffett remains optimistic about their long-term prospects.
He believes that the housing market will eventually recover, and that when it does, Clayton Homes will be well positioned to benefit. Plus, their conservative lending practices and their focus on serving a growing demographic give them a solid foundation for future growth.
So it's a story of resilience and cautious optimism.
Exactly. Despite the challenges, they've managed to stay afloat, and they're ready to capitalize on the eventual rebound of the housing market.
Well, we've covered a lot of ground in this second part of our deep dive into Warren Buffett's 2011 letter.
We've delved into his thinking on productive assets, his approach to managing a diverse portfolio of businesses, and his insights on the housing market and the broader economy.
And through it all, we've seen those core principles that guide his investment decisions: patience, discipline, long-term thinking, and a belief in the power of American ingenuity.
He's a true icon of investing, and his wisdom continues to inspire and educate investors of all levels.
Okay, so we're back for the final part of our deep dive into Warren Buffett's 2011 letter to Berkshire Hathaway shareholders. We've covered so much ground, from those steady earners like See's Candies to those big operations like BNSF.
Yeah.
But now I'm really excited to dig into something that I think a lot of listeners are curious about: Berkshire's stock portfolio.
Yeah, this is where we see Buffett's philosophy in action. He's always talking about intrinsic value and long-term thinking and all that. Well, this is where the rubber meets the road.
So let's jump right in. What were some of Berkshire's biggest stock holdings in 2011?
Well, he actually highlights those holdings with a market value exceeding $1 billion. And it's a list that I think a lot of investors would recognize. We're talking about companies like American Express, Coca-Cola, IBM, Wells Fargo, Procter and Gamble, those blue chip American companies.
Yeah, those are the names you see in everyone's
Okay.
portfolio. But I think what's interesting is how he approaches these investments. It's not just about buying a stock, it's about buying a piece of a business.
He's looking for those companies that have a strong competitive advantage, those moats that he's always talking about. And he's looking for companies with management teams that he can trust, people who are going to be good stewards of capital.
He said it before, right?
Right.
He's not looking to buy stocks, he's looking to buy businesses. He wants to own a piece of something that's going to be around for decades to come.
Exactly. And even with this long-term view, he's not afraid to make bold moves. In 2011, he added a significant position in IBM, and he also made a big investment in Bank of America, which was still recovering from the financial crisis.
That Bank of America investment was really interesting. A lot of people were still pretty skittish about banks at that time, but Buffett saw an opportunity.
He's a contrarian at heart.
Yeah,
He's not afraid to go against the crowd and buy when everyone else is selling.
And those warrants he got as part of that Bank of America deal, that was just classic Buffett. Always finding a way to get a little extra.
He's a master negotiator. And his investment in IBM was equally intriguing because he'd always been pretty skeptical about tech companies. He said they were too unpredictable.
Right, he always said he didn't understand them well enough, but with IBM he saw something different. What do you think changed his mind?
Well, I think he recognized that IBM was more than just a tech company. They had a long history, a strong brand, and a very loyal customer base.
And a huge global reach.
Exactly. And I think he saw a company whose stock price was undervalued relative to its earning power and its long-term prospects.
So he was betting on the staying power of IBM, their ability to adapt to the changing technological landscape and continue to deliver value.
And I think he was also impressed with their management team. He saw people who were focused on creating shareholder value.
And let's not forget about those smaller stock holdings managed by Todd Combs and Ted Weschler, his two new investment lieutenants.
Ah, yes, the dynamic duo. They're like the young apprentices learning from the master.
Exactly. And he's clearly giving them a lot of responsibility. They're each managing portfolios worth billions of dollars.
He's grooming them to take over someday. It's all part of his long-term succession plan.
It's like he's building a dynasty.
Yeah.
Now let's talk about something that I think can be really intimidating for a lot of investors: derivatives. These are complex financial instruments that can be very risky if you don't know what you're doing.
Yeah, they're definitely not for the faint of heart. But Buffett addresses them head-on in this letter, and he explains how Berkshire approaches these investments very cautiously.
So they're not just diving in head first, they're taking a very measured approach.
Exactly. He says they avoid those contracts that could require them to put up a lot of collateral. Those margin calls that can really hurt you if the market moves against you.
So they're all about minimizing risk and making sure they have enough cash on hand to weather any storm.
They're playing the long game. They're not interested in making a quick buck. They're trying to build a fortress that can withstand the test of time.
And he also talks about how the regulatory landscape for derivatives has changed, which has made them less appealing for Berkshire.
Yeah, the rules of the game have changed, and Buffett is adapting his strategy accordingly. He's always willing to adjust his approach based on the current market conditions.
Now let's talk about another asset class that Buffett has some strong opinions about: gold. A lot of people view gold as a safe haven, especially during times of economic uncertainty. But Buffett has never been a fan of gold.
He's actually quite critical of it in this letter. He calls it an unproductive asset. It doesn't generate any earnings or dividends. It just sits there doing nothing.
He famously said that gold gets dug out of the ground, then we go melt it down, we turn it into bars, then we stick it back in a vault and we pay people to guard it. It's like this weird obsession with shiny metal.
Exactly. And he argues that it makes much more sense to invest in productive assets, things like businesses and farms that actually produce something of value.
So instead of putting your money in a vault, you're investing in companies that are creating jobs, building products, and driving economic growth.
And that's really at the heart of Buffett's philosophy.
Mm.
He believes in investing in things that create real value for society.
Now, before we wrap up this deep dive, I want to touch on one more thing that Buffett talks about in this letter, the role of government in the economy. And I think it's really important because it shows his deep faith in the American system.
He acknowledges that there were mistakes made leading up to the financial crisis. There was a lot of blame to go around. But he also believes that the American economy is incredibly resilient and that it has the ability to self-correct.
He's not a doom and gloomer.
Yeah.
He's a believer in the power of the market and the ingenuity of the American people.
He thinks that the best days for America are still ahead of us. And that's a really powerful message, especially when you consider the challenges that we're facing today.
It's a reminder that even in the darkest of times, there's always hope. And that if we work together, we can overcome any obstacle.
Absolutely. Well, we've reached the end of our deep dive into Warren Buffett's 2011 letter to Berkshire Hathaway shareholders. And I have to say, it's been a real pleasure exploring this letter with you.
Me too. It's always fascinating to peek into the mind of one of the greatest investors of all time. And I think there are so many valuable lessons that we can all learn from him.
His emphasis on long-term thinking, his focus on intrinsic value, his belief in the power of compounding, his willingness to be patient, and his unwavering faith in the American economy.
These are timeless principles that can help any investor achieve success in the market.
And they can also help us navigate the challenges of life in general.
So I encourage all of our listeners to take these lessons to heart and to keep learning and growing as investors and as individuals.
Remember, the journey of investing is a marathon, not a sprint. So stay focused, stay disciplined, and never stop learning.
Until next time, keep diving deep.